Cummins India came out with numbers which looked pretty strong operationally, and while the stock reacted negatively yesterday, brokerages have come out fairly constructive after the con call, despite the fact that there might be some competitive intensity increasing in the second half of the current financial year. Mr. Ashwath Ram, Managing Director at Cummins India, joins in to talk about FY24, but more importantly, what could be near to medium-term hold in store. Mr. Ram, great having you. Thanks for taking the time out. Good morning. Hope all is well. Neeraj here.
Thanks, Neeraj. Everything is good.
Great. And just trying to wonder if everything stays that way, because it's a volatile world. Your exports have come off a little bit despite a very robust showing that you've done in Q4 and arguably FY24. How do you see the lay of the land for the next 12 months?
Yeah, I think exports are getting ready to bottom out. There are still all of these geopolitical crises in the Middle East. China is still not picked up completely. Africa has a lot of currency-related problems. Latin America has slowed down. Europe has slowed down a lot. So we are seeing demand across all of our export markets is down, and we expect it to probably bottom out by next quarter and then start to recover again. So the short-term outlook is slightly bearish as far as the export markets are concerned. But the long-term outlook continues to remain positive because we've got so many new products and so many more markets that we can reach.
Okay. But which is heartening to hear if indeed exports are in the process of bottoming out. Though I can understand completely if I have a difficult call to give about the timelines. It's just such a volatile a world. Talking about India, Mr. Ram, the CPCB plus norms, right? 1st July 2024. Now, I presume you've been ready for it now for a really long time. I just wonder, when you scan the landscape, how ready to your mind is competition as well? Would you have a bit of an easy run in the initial stage? Do you reckon competition will pick up? And what does that do to pricing power / margins?
Yeah, it's quite tricky to answer that. We have been ready for a very long time. We've been ready for over 18 months. We've been selling products right from the start of when the norms came into effect, which was in June of last year. And with the extension, everyone has had an additional 1 year to prepare. So my assumption would be that almost everyone should be ready. My assumption also is that we have not seen the full impact of competitive pricing in the market yet. And only those niche customers who've been buying the CPCB4 plus products in a couple of the regions around the country have been paying for the product. Once bulk production comes in, we will know the reality of what the exact margins of CPCB4 are. We expect them to still be incremental to CPCB2. As far as readiness is concerned, we are overly ready, and we don't see any dip in the domestic market because of a pre-buy or any transitionary period. But I would also assume that others are ready, and so we will have the regular competition in the market. We think we've had 18 months to test some of the best products that are available in the country. And so that does give us confidence that we will be able to continue to perform well in the markets.
Mr. Ram, hi. It's also Samina joining in. Help us understand the split between your domestic volumes and your global volumes, and also going into the next couple of years. What is a fair expectation in terms of annualized compounded growth for, say, maybe the next 2 to 3 years?
So right now, when we look at all the markets, it's roughly like a 25% to 75% kind of split, roughly. Don't quote me on the exact number. I'm telling you from the top of my head. But our ambition is that exports should be somewhere between 35 to 40% of our revenue. That is what we are aspiring to do. So we will continue to focus on increasing exports out of India, and we'll continue to develop products and attempt to grow that share within the pie. as the pie keeps expanding.
Mr. Ram, so if you're looking to push exports to up to 35–40% as the pie gets bigger, what I want to understand, and I'm making an assumption that exports are better margins in terms of business, and hence it's better business sense to do that. On the margins, we've seen a clear improvement. In terms of core operating margins, what does that stand at? And where do you see that go over the next financial year? I ask you this because I do know that raw material prices have been on the uptick.
So a couple of ways to answer that. The first is that export margins are slightly better than domestic margins, not dramatically better than domestic margins. But what exports does is it balances out the ups and downs of a very cyclical power generation market within the country. So if you have a bigger ratio of exports, you're able to even out some of the volatility, because global markets react slightly differently from the way India works. The second is we have been focused on improving the core margin across all the businesses. So if you look at a 5-year kind of trend, we have continued to improve the margins in every part of the business. So even if commodities are to go up, and right now we have the perfect storm of good news in that our mix is good, commodity prices have been reasonably stable, we have been able to hold the pricing, so all variables have been favorable to us. It is unlikely that this kind of scenario can just continue forever, but we continue to focus on cost, we continue to focus on attempting to hold or retain the kind of margin aspirations that we have had as a company. So one of the things I've been saying is that we are not doing growth just for the sake of growth. We are doing growth, we want profitable growth. And for that, we continue to focus on all aspects which relate to profitability, which is cost, which is design, which is efficiency. So we continue to focus on all those variables.
Ram, Tamanna here, and you talked about a variety or a set of variables which could impact growth. I was wondering how you look at the uncertainty in global metal prices in that picture, because I think that was a question you faced in the con call as well, and you did say that it would pose a challenge to gross margins. Can you elaborate on that?
Yeah, if you look at all the big variables that go into production of our products, things like copper, steel, nickel, all of those variables, including that of crude oil, etc., over a 3-year trend have now bottomed out as far as the commodity prices, and are now starting to trend upwards. So because we were able to, when we increased prices when the commodities were really high, and we were able to hold the prices as the commodities went down, now that the commodities start to increase again, expecting the same level of margin is going to be, maintaining the same level of material margin is going to be difficult. Of course, that doesn't mean that we just say, okay, we are at the mercy of the commodities, and whatever happens up or down, there's nothing we can do about it. That's why we work on controlling cost, we work on controlling efficiency. We do have a product by which we can get better margins, etc. So we will try to offset a certain chunk of commodity price increases through all of these actions.
Yeah, so just that one bit, it sounded interesting. The product that can help offset, margins. Can you tell us more about that?
Yeah, so for example, as we are going from CPCB 2 to CPCB 4+, it's a higher technology product. There is more value-added content. There is more of the whole chain that is produced by Cummins. So that helps us have a better cost profile and therefore have better margins on the product. And if the same product we can take and we can then export into other markets, then we have leverage on scale as well. So that also helps to have a lower cost profile so that margins can be better.
Okay. Mr. Ram, just over the next 24 months, I'm just intrigued. We were speaking to a global economist of Nomura who mentioned that just by virtue of how there is a natural a change of China vacating a lot of pockets which it was earlier present in, and ASEAN economies getting into that fray, would mean that a lot of focus of production in ASEAN for the world would pick up. I'm correlating that with your earlier answer about how you believed exports are bottoming out, and an earlier conversation with all, or rather a conversation with all MNCs about whether India becomes a hub naturally because of the ability to produce on scale at cost. Can the buoyancy in export growth be much stronger than what the street might envisage over a 3 or 5 year period?
It can, provided we fix some of the fundamentals within our economy. The ease of doing business continues to remain a challenge. We continue to have higher costs of energy. Logistics is still a challenge. It takes a lot more time for material to flow within our country, and logistics as a percentage of cost out of India are still higher than in some of those other markets. So combination of all of those aspects, as long as we're able to fix, we're able to have better infrastructure, we continue to invest and grow the scale, we continue to deliver very high quality of product. I don't see any reason why we should not see very robust growth in the exports market.
Sorry, just one last question. That could take your capacity utilization levels, if it works out for you, Mr. Ram, higher than where they are right now, let's say even in FY25?
I think so, because as of now, our utilization based on the invested capital is roughly about 50%. Based on manned capacity, it is greater than 90%. So it's very straightforward for us to add in more people and grow capacity if as the demand picks up.
So hi, it's I'm Samina again, and I want to understand from you about your data center business. It's becoming, it's growing, and I think the focus on this is there going into the next couple of years. Over the next 2 to 3 years, how much of Powergen revenue could be coming from data centers?
So it's grown very rapidly. In the last 3 years, it has grown from almost 1 or 2% of our business to nearly 10% of our power generation business. And globally, it's even bigger for us. It may be as high as 20% of our global power generation business. And the demand is so high that some of our factories globally are booked for somewhere between 12 to 18 months. So this market segment continues to grow very robustly, not only in India, but around the world. We don't see any slowdown in this segment, at least for a couple of years. As we are one of the leading technology providers in this space, we think the opportunities will continue to grow for us and become a larger share of our pie.
Larger could it get, Mr. Ram, over the next 2 to 3 years? I mean, you've gone from 1-2% to 10%, like we just spoke about. How significant can this be? And also quantify it for me, if possible, not just percentage and actual numbers. If there is an in-house number that you're focusing and working towards.
We're not really focusing on a very specific number, but certainly the opportunity in the next 3 to 5 years is for it to double again. So that's the scale of opportunity. It's pretty phenomenal. And we are developing the whole range of products. A big chunk of those products are being localized or are already localized. So we have a good market position to be able to compete in that space.
All right. Thank you so much, Mr. Ashwath Ram. Fantastic speaking with you.